For many first-time investors venturing into real estate, investing in residential property is the most straightforward and easy to understand. Yet a narrow focus may cause an investor to lose sight of other potentially more lucrative opportunities. One opportunity in particular are self-storage facilities, and the need for them is vast. Historically low interest rates and the asset's positive fundamentals are starting to draw investors to self-storage with record speed. Self-storage is typically classified into three classes, A, B, and C. Class A are newer facilities built within the last 10 to 15 years. They feature modern amenities, are professionally managed, charge high rent, have low vacancy rates, and are well located. They'll often be coupled with other akin uses, such as a U-Haul rental or a UPS store. Class B properties are usually 15 years older or more. They're well maintained but may lack 24/7 on-site management. They have limited amenities and feature low to average rent prices, usually located close to main roads, but not necessarily in prime locations. And Class C facilities are older and in less desirable locations. They have few, if any, amenities and limited security, often have the lowest rent, and may require significant property improvements in order to have the potential to generate a sufficient return for investors. There is no best or worst class of self-storage. Each of these asset classes can be a worthwhile investment. Keep in mind that self-storage is not a foolproof investment. Here are some of the most pertinent pros and cons to consider before investing. Pro: a low-maintenance asset. Advances in technology such as lighting and security systems allow owners to operate self-storage facilities with relatively little supervision. Moreover, very little maintenance is required. Con: short-term leases. Generally operated on a month-to-month basis, which could result in high turnover and require an operator to consistently market the property to ensure units are quickly released upon turnover. Pro: a potentially stable cash-flowing asset class. Due to short-term leasing, the owner can evict a tenant for non-payment of rent and then lease that unit to a new tenant. Owners can even marginally increase rents per month. Administrative fees, late fees, and retail sales may even further boost cash flow. Con: potential risk of oversupply. Self-storage facilities are relatively inexpensive to build and are often rapidly built during times of high demand. However, once demand tapers, it can result in an oversupply that puts downward pressure on rents at all facilities. Prospective investors should consider both existing and planned competition within a certain radius of their facility. Pro: potential to diversify income streams. Self-storage operators with well-located facilities can gain a secondary income by diversifying the products or services they offer. Operators should consider offering unheated outdoor storage, partnering with a kin facility like U-Haul, and operating additional industrial services such as a fuel station. Con: not entirely hands-off. While there is a lot that can be done to lower operational costs, these properties still need active management to ensure their success. Ongoing repairs and maintenance are necessary to keep the property in proper working order. It's encouraged that an investor has a strong business plan in place prior to purchasing a self-storage facility. And Pro: historically recession resilient. When the economy is good, people move, invest in home renovations, and buy more goods. During recessionary periods, people downsize, move in with roommates, and are sometimes evicted from their apartments. Each of these scenarios typically increase demand. So you might be asking yourself, is self-storage right for you? There are many reasons to consider investing in the self-storage industry, and it remains a highly fragmented asset class. Many facilities are still owned by mom-and-pop operators who are on the verge of retirement. This creates an ideal opportunity for those looking to enter the market for the first time. At Perch Wealth, our team would be happy to sit down and discuss our investment model with prospective investors. We're here to help you achieve your investment goals. Contact a dedicated representative today or visit perchwealth.com for more information. This video presentation is not an offer to buy or a solicitation to sell a security. The video is a discussion pertaining to one or more investment strategies and/or asset classes, and is not a discussion of any specific offering, past or present, of securities. As a reminder, there is no guarantee that any investment or strategy will perform as targeted, and any investment involves the risk of the loss of some or all principal invested. This video contains statements intended for educational and hypothetical purposes only, and is not to be construed as a promise of performance. Information presented herein reflects the opinions of the speakers and is from sources believed to be reliable, but all information is subject to change. Not an offer to buy, nor a solicitation to sell securities. Information herein is provided for information purposes only and should not be relied upon to make an investment decision. All investing involves risk of loss of some or all principal invested. Past performance is not indicative of future results. Speak to your finance and/or tax professional prior to investing. Securities offered through Emerson Equity LLC member FINRA SIPC. Only available in states where Emerson Equity LLC is registered. Emerson Equity LLC is not affiliated with any other entities identified in this communication. There is no guarantee that any strategy will be successful or achieve investment objectives. Potential for property loss. All real estate investments have the potential to lose value during the life of the investments. Change of tax status. The income stream and depreciation schedule for any investment property may affect the property owner's income bracket and/or tax status. An unfavorable tax ruling may cancel deferral of capital gains and result in immediate tax liabilities. Potential for foreclosure. All financed real estate investments have potential for foreclosure. Illiquidity. Because 1031 exchanges are commonly offered through private placement offerings and are illiquid securities, there is no secondary market for these investments. Reduction or elimination of monthly cash flow distributions. Like any investment in real estate, if a property unexpectedly loses tenants or sustains substantial damage, there is potential for suspension of cash flow distributions. Impact of fees and expenses. Costs associated with the transaction may impact investors' return and may outweigh the tax benefits.